Welcome, everybody. We're really excited to have you with us, and we're excited to be here with the Linzers from Linzer Consulting to talk about the third resource, fully secured borrowing. My name is Michael Wallenfels. I'm the communications manager here at the Washington State Arts Commission, ArtsWA, as you may know it on the streets. I'll be your tech guy. So if you're having any kind of trouble with Zoom, with hearing things, or whatever it may be, go ahead and send me a private message on chat, which you can open up a separate window and then drop down and select me from that and shoot me a note. And I'll try to help you out. So to go through our agenda for today, the first thing I'm going to do actually is drop the link to the third resource manual. You should have had this link in your registration and in your confirmation email, but if you didn't or haven't clicked it yet, please go ahead and do so now. That link is in chat. So what we're doing today, let me get over to it. We're going to introduce Richard and Annie, and they're going to take you through background about fully secured borrowing, take us through a short case study, and then we have questions that we've prepared, and then we'd love to hear some questions for you. We'd ask that you save these questions for the end, and to ask them, you can either put it in chat, or if you'd like to, you can unmute and speak. But again, please save that for later in our program. All right. So now I am going to introduce our guests, Richard and Annie Linzer. Richard and Annie Linzer from Linzer Consulting. Anna, or as we call her, Annie, and Richard have both worked together separately for the past 30 years. Annie is a poet and writer. She received an American Book Award in 1998 for her novel Ghost Dancing. Annie's most recent book of poems, Season Unleashed, was released this year by Empty Bowl Press. In addition, her 3 novels were brought together in a trilogy entitled Home Waters. Somehow, she's found time to co-author with Richard 13 books, workbooks, and kits that address issues in the nonprofit world, such as planning, board development, institutional assessment, and financial management. One of these books, called It's Simple, received a Terry McAdam Award for Outstanding Contribution to the Advancement of the Nonprofit Sector from the Alliance for Nonprofit Management. Richard and Annie work as meeting facilitators using an approach they have developed over many years. He also works as a consultant in areas such as strategic planning, board development, institutional assessment, and financial management. Since 1965, he has consulted with over 600 businesses, government agencies, and nonprofit institutions in the arts, education, healthcare, social services, the humanities, and environmental fields. He specializes in the use of credit by nonprofit organizations. His practice includes rescuing nonprofit organizations in serious financial trouble, using credit to conduct unconventional capital campaigns, and demonstrating the cost savings to institutions by using fully secured credit as a substitute for cash reserves and endowments. Richard and Annie, did I miss anything? Did I cover your background well enough?
I think you did fine, Michael. Very well.
Thank you.
Thank you very much. And with that, I'm going to hand it off to our guests to take you through this information. Again, if you have any tech issues, go ahead and send me a message in chat. And if you have any questions, please save them for the end and hold on to them. And with that, Richard and Annie, I hand it to you.
Thank you and welcome. We're delighted to be here and we're happy to see, or at least partially see, all of you. Tonight, we're going to discuss our approach to fully secured borrowing. Using it, we've found a way to go outside of the traditional system of philanthropy to secure funds. Fully secured borrowing is one of the best means to ensure that nonprofit organizations can defend and protect themselves, particularly in these times. It's a form of inexpensive risk insurance that allows local people to support nonprofit organizations at no cost to themselves. This support translates into funds that can be used to address timing issues and much more. We've used this approach to rescue organizations such as Northwest Folklife and the Santa Fe Chamber Music Festival, a number of others. We've also used it to deal with somewhat more complicated problems. These have included unconventional capital campaigns for West Sound Academy, the Marine Science Center in Paulsbo, the Suquamish Museum, and the Leather District, Artist Lofts in Boston. We also consult, as Michael suggested, with organizations about using fully secured borrowing to save money in the place of cash reserves and endowments. Tonight, we will answer your questions and gently urge you to try this approach. We have found that working in tandem, the three resources, gifts and grants, number one, number two, earned revenue, and finally, the third resource, fully secured borrowing, provide a substantive, a solid financial base for nonprofit organizations. Since Annie and I also work as facilitators, we are committed to the idea of trying to make it easy for people, and particularly for people who are busy and need to be productive. That thought has carried over into our work in this financial realm. That's why we compress material from our 5 books into the free manual we're sharing. All the needed forms, letters, contacts, budgetary templates are included in the manual. Our intent is for you to find the approach to be simple and easy to use. Over the last 4 decades, we found that much of the steps involved in fully secured borrowing are familiar to people in the nonprofit world. It's not all that different. What is the challenge for us is trying to explain why borrowing is so important when gifts and grants are really on everyone's mind. And so if you bear with me for a few moments, I'd like to provide a little context that we believe answers this question. Financial woes in the nonprofit sector actually have a long history. In the past, governments have canceled funds, foundations have changed granting policies, donors have been fickle, pledges not always fulfilled. During COVID, the difficulty of assembling in groups resulted in dramatic declines in earned revenue in many fields. And today we see grant programs imperiled by sudden shifts in government priorities. In the midst of these current circumstances, there are also some perennial issues that need to be addressed. For starters, you're all competing for a relatively small, generally inelastic pool of funds. The IRS, through its Statistics on Income Division, issued a report which was picked up by the Chronicle of Philanthropy that pointed out that the top 5% of all nonprofits, and this excludes foundations, obtain 80% of all the revenue in the fields. In other words, they get the lion's share of gifts and grants and the earned revenue. And of course, what that means is that the rest of the nonprofit sector, the other 95%, are having to struggle to obtain that leftover 20%. In addition, there is the inevitable truth that money costs money. We use what we think are the best statistics in the field. They come to us from the Association for Healthcare Philanthropies. And what they tell us is that larger, more mature nonprofits, ones who've been in business for between 5 to 10 or more years, spend a median of 25 cents, median being half above, half below, to raise $1. Other smaller, newer organizations can spend up to a median of 70 cents to raise $1, and many of them spend more. It's important to understand that these are all organizations that have full charge development offices. So it's an important aspect of the context in which you're operating. We know the philanthropic community wants you to spend 10 cents to raise $1, but the facts on the ground just don't bear it out. It also costs money to earn money. In general, institutions can spend anywhere between 90 cents to 99 cents to raise $1. In some cases, it's much more. So the next time you go to the theater, if you look at the bottom of your playbill, you may see an announcement which says, your tickets just paid for 1/2 of our annual budget, which is another way of saying we just spent $2 to get your $1. Of course, foundations, donors, corporate sponsors, government agencies make up the difference. But again, you get the idea of the cost of earned revenue. And then there are a set of broader issues which are directly addressed by fully secured borrowing. And I'd like just very quickly to touch on them with you. The first one is that the bottom line budget, the annual summary budget that almost everyone uses, you know, the one where income and expense are summarized for a year and then your eye goes down and there's a number at the bottom. These types of budgets are often not very helpful for board and staff members to understand the financial position of a nonprofit organization. And they are definitely not helpful to bankers. And we'll talk about that in just a moment. A second issue is that accrual basis accounting, which incidentally is a wonderful system of accounting, but is a virtual system. And sometimes this creates confusion for people in understanding the cash that is actually available to them because of the way in which that accounting system works. It's important to understand that often financial problems can go undetected if financial information is inadequate. And you'll see examples of that in just a moment. We have found in the past that board and staff members tend to react to shortfalls by a rallying cry that says, let's raise more money, or they call for cuts in operations, the operations that generate earned revenue. After all, saving money always seems like a good idea. But often the real problem is time, not money. The nonprofit sector has been called the land that time forgot because timing is so difficult due to the lack of coordination among the sources of gifts and grants. So time is something that we are going to be talking about and looking at in the course of today. When things are dire, and they certainly are now for many institutions, often those institutions ramp up their pleas for help. And you'll see this in your email message box. Unfortunately, this can backfire if the issue of the solvency of the organization seems to be in jeopardy. Some donors, government agencies, and many philanthropic institutions turn away from what they perceive as failure. And finally, substantial savings can be obtained by using fully secured borrowing as an alternative to cash reserves and endowments. And although it's a little technical, we can talk about that a little bit later. All of this taken together means that we believe that you need to find different ways to manage your money, and particularly to expand the money available to you outside of the conventional sources of funds. This is particularly true for money that is used for operations, for working capital. Fully secured borrowing will enable you to get the funds you need when you need them. As an example of all of the issues that I've just discussed, the Northwest Folklife case study probably encapsulates them as clearly as any other case study we have. And so I'm going to ask Annie if she'll share the case study with you.
I will. Okay. Through tireless volunteer effort and strong community support, the annual Northwest Folklife Festival has become a Seattle tradition. For many years, the small nonprofit that operates the free event had managed to sustain itself on income from concessions, underwriting from a small number of corporate sponsors, and a handful of grants from local arts councils and foundations. Those who flock to the festival every Memorial Day weekend also contribute by buying buttons and making small donations on the festival grounds. In the 1990s, a large national foundation awarded Northwest Folklife a substantial multi-year grant. The original grant proposal had been written by the founding director with the aim of enabling the festival to expand into a year-round program with an entrepreneurial twist. Educational activities, bazaars, publications, record releases, and product sales were envisioned as a new revenue source that would support the organization and bankroll the festival. Board members were delighted with the grant, and the new staff were hired to develop the array of money-making ventures. The organization set up set about ramping up to take advantage of the multiple markets in its new divisions that were designed to tap. Then costs began to climb. But the board assumed this was only to be expected. Several board members were successful businessmen. Others were sophisticated participants in the technology boom in Seattle. The word in board meetings was that sometimes it takes investment to reap a big reward. The foundation grant did cover salaries of the newly hired personnel, and foundation officials were encouraging even more aggressive market-oriented activities. It was only a matter of time before all these new ventures would start paying off, or so it seemed. When bad weather over the 1997 Memorial Day weekend kept crowds home, revenues from the festival fell sharply. And despite the hard work and long hours put in by staff, most of the money-making enterprises failed to perform as hoped. The returns were just not there. An unsecured line of credit with a branch of a regional bank was now fully extended. The bank's president, who was a longtime supporter of the festival, had been the one to urge the local branch to extend credit without collateral. Now vendors were demanding to be paid. The director and business manager spent more and more time fending off their concerns. The finance committee met again and again, but all they could come up with was a call to raise more money. As preparations for the next year's festival went into high gear, everyone's hopes were pinned on the weather, glorious sunny weather. Memorial Day weekend, 1998, turned out to be one of the wettest, coldest weekends on record. The rains were relentless, the crowds never showed, the festival took a bath. Management had purchased a limited weather insurance policy, but for the policy to pay out, a fraction of an inch more rain would have had to have fallen. Faced with a growing fiscal crisis, the board brought in a woman with considerable financial experience to clean up the books. What she discovered was alarming. The reporting had not been accurate. The organization had maxed out its line of credit at $160,000. The deficit, including the line of credit, was approaching $430,000. On a budget of less than $1.3 million, this was simply unacceptable. The staff groused. The bank called its line of credit. Vendors threatened to sue. The board asked for and received resignation of the director, and the local media ran stories reporting the festival's apparent demise. Under the leadership of a new board president, Irene Namkang, and her husband, John Ullman, the board rallied. They hired a new director, Michael Hershenson, the former director of Seattle's Museum of History and Industry. Richard had previously worked with Irene, the president of the board of the Western Alliance of Arts Administrators, and she knew that we specialize in the use of credit by nonprofit organizations. So we were called in to meet with the board. Initially, they were very reluctant when we suggested that they consolidate their debt and asked their bank to grant them a long-term loan, plus a revolving line of credit to deal with current operations. To provide collateral for the loan, we suggested forming a credit holder group. They insisted they simply needed to raise more money. When it then became clear that they had no history of raising substantial funds and frankly did not know how to raise the money they needed, we were called back. Irene, John, and Michael went to work, and within weeks, the board was able to secure credit holders' deposits amounting to more than $500,000. Normally, this would have been enough for any bank to offer a term loan covering the $430,000 deficit. But this bank, perhaps because of its previous sloppiness, began imposing more and more conditions until the credit agreement had grown into a massive Byzantine document with enough subclauses to make a reader's teeth itch. After conferring with the board and staff, it was decided to approach another bank, one that was small and local. 2 business days after meeting with a loan officer, a deal was finalized with using a standard collateral agreement. Once the line of credit and long-term note were secured, Northwest Folklife was able to pay off its debts. The return to solvency prompted favorable publicity, and that made the organization more attractive to donors. One credit holder even issued a $200,000 challenge grant. Suddenly, the pendulum was swinging the other way. With a vigorous fundraising campaign and improved weather, at least by Seattle standards, at the 1999 festival, Northwest Folklife was finally able to recoup much of its earlier losses. The organization ended the year with a surplus and began carefully paying down its loan. Folklife sustained its operational needs through a revolving line of credit. By using a line of credit and long-term borrowing, the stability and vitality of Northwest Folklife was restored. Access to collateral made it possible to deal with the organization's deficit in a measured, responsible way and to renew public confidence in a venerable institution's long-term survival. This year, 2025 Northwest Folklife had great weather and continues to attract thousands to the Seattle Center.
Thank you. Well read.
Oh, thanks.
Thank you, Richard and Annie. Before we get to the questions from the group we have assembled here, I have some questions for you. The first one is maybe seemingly very simple. And just tell us, what is it? What is the third resource? What is meant by this?
Well, all nonprofits have access to 3 financial resources. The first is gifts and grants, the second is earned revenue, and the third is fully secured borrowing. And our focus this evening, obviously, is on that. Fully secured borrowing is really what gets organizations through rough patches like this, and it provides the base that will enable an organization to safely continue with its fundraising and earned revenue. By fully secured borrowing, we mean you place a dollar in the hands of your bank. This in turn forms collateral, and that collateral comes from your supporters, people called credit holders. In turn, the bank agrees to lend you a dollar. The cash collateral fully secures your organization's borrowing. The bank then makes credit available to you in the form of a revolving line of credit or a term loan, or in some cases, cash needed for other activities. So long as you have cash collateral in the banker will continue to lend to you.
So why now? Why this moment?
Well, I think primarily because nonprofit organizations are being defunded. And in some cases, this includes grants that have already been awarded. This is a very serious challenge for most organizations who do not have in place the risk management that something like fully secured borrowing provides.
Can you talk about how this applies to like rural and small communities?
Well, we have found in the past that many of these communities lack big donors or foundations, but they typically have banks or they have access to a bank nearby. This approach allows local people who are motivated by their desire to support an organization to act in a positive, constructive fashion at no cost to themselves. The money from the bank, which is outside of normal philanthropic channels, is still money that can be used for a variety of purposes, to smooth out cash flow, offset deficits, and also to provide capital for some new ventures.
Well, why pursue the third resource instead of focusing on increasing the first two, earning and raising more money?
Well, for the last 40 years, this has been the one question I've heard over and over again from nonprofit administrators and board members. The question always is, why would we borrow when our focus is on gifts and grants and earned revenue? And my answer is very simple. It is, of course, you should apply for gifts and grants. Of course, you should obtain as much earned revenue as possible. But as we see a decline in donations, resulting in part from the government, but also from other philanthropic sources, we are seeing that the need for organizations to step outside of that conventional pool is greater and greater. And this really is the time to use fully secured borrowing.
What's the history of this? Where did this idea come from?
Well, like many good ideas, it's a result of failure. In the mid-70s, the Massachusetts Arts and Humanities Foundation, which is an organization that gave grants to individual artists in 11 different disciplines, needed an executive director. And so I was hired and I flew up to Boston. And shortly after I got there, I discovered that the state legislature had simply decided to cut all the funding to the arts. And that meant that the organization that I was about to direct was going to take a very, very severe hit. The foundation was an operating foundation, which meant it had no endowment. My staff and I had to raise all the money for the awards and for operations. So this cut meant that we really were going to have to do some serious hustling. My first thought was to go to the foundation's bank and apply for a line of credit. It seemed logical to me. I went, I applied, the bank said, absolutely not. We don't lend to nonprofits, period, full stop. I then approached 12 other banks and got exactly the same message. Now, when people say guys are slow, I'm living proof. It was only after failing over and over again that I finally realized that I was the one who had to change. The bankers were certainly not. And so I began to rethink what was my approach to bankers. And I decided, I think probably more than anything else, that since the bankers were not going to change, I was the one who would have to. I had to come to understand how bankers operate.
What'd you learn? What'd you realize?
Well, bankers are like the people who rent tools, except they rent money. Unlike the tool shops, banks want reassurances that you'll pay them back, that you'll bring back their product. And if you don't return it in a timely fashion, they'll pursue you. So before when I said unlike, I really meant like. Yes, thank you. Precision and progression, poetry. Very helpful. So banks, like the local tool shop, pay a lot of attention to time. Time is really important to them. And so for starters, I felt that I needed to strip things down to essentials. And so I took a position that the thing that bankers wanted was, first of all, the quality of collateral, and second of all, a way to mitigate the downside risk that they incur that you won't pay them back. It turns out that using fully secured borrowing answers both those questions. The money that credit holders provides cash, which sits in the bank's vault. And then the banker can see that he or she is without risk. This makes them very, very willing to consider the possibility of lending. Now, of course, in addition to the collateral, you also need a cash flow budget and you need some projections, but we can talk about that in just a minute.
All right. Well, how do the nonprofits go about getting the collateral?
Well, the key is something we call credit holders. We all know that the problem for nonprofits is that most of them lack the collateral that bankers really want. The hundreds of pairs of roller skates that were donated to the orphans or the boxes of slightly used toe shoes are just not going to cut it as collateral. So instead, the key is to urge people who support you to use that desire to create the collateral you need. Faced with that problem many years ago, we came up with the idea of a new volunteer in the nonprofit world. We call these volunteers credit holders. Credit holders may or may not be donors, but unlike donors, they simply park money with you for a fixed period of time. And when the time is over, they either get their money back or they can roll over the collateral that they've parked with you. over the years, we discovered that people really love this idea. The person who annually will send you a $25 check often will feel very comfortable parking $250 or $2,500 in a collateral account. It's their money. They retain the ownership. They get interest from the bank. There's no tax benefit to credit holders. But what they get is the opportunity to support you over a long period of time in a way that costs them virtually nothing.
But it's time-based. They park it for a certain length
Right.
of time. It's not parked forever.
No, not parked forever. And we also found that this really dovetails with development efforts. For example, we talked with someone the other day who said that he had gone to a donor and said, I'd like you to donate $1,000 this year. And the donor said, well, I'm having kind of a rough time in my business. I think I'm going to pass. And the development officer said, well, what about parking $1,000 in this collateralized pool that we're creating? And the donor said, that's a great idea. I can do that. I can park some money with you, even if I don't donate this year. So there is a kind of synergy. There's a kind of operation that works together with that.
Who are the credit holders? Can you tell us what kind of people they are, what kind of backgrounds they have?
Well, they're friends, they're neighbors, they're colleagues, they're supporters, they're people that your board knows. There are people who are interested in you, but their interest is a little different than the donor. The donor is someone who supports you, one and done, and then you remind them next year during the annual drive, to come back in. Credit holders are people who sustain a much longer interest in organizations.
And they're watching their money, so they want you to do well. And they'll tell people to come to the festival or whatever, because without even knowing it, you've got a stake in it that you're watching and you care about.
So how do organizations go about getting credit holders?
Well, the first thing you do is you need to present this idea to your board and ensure their willingness to participate. This is critical. Board members are the leaders in these efforts, and they're the ones who often are going to take a position in reaching out to credit holders. In the manual that we presented to you, which in some ways is more like a cookbook, it has a bunch of recipes. It has, among other things, sample solicitation letters that have been used in the past very successfully. And like any recipe, you can modify it or change it, or you can simply plug your organization's information into the letters and send them out to try to share them with credit holders. It's important, though, that you create a cash flow budget, we'll talk about that in a bit, and make some projections. That's going to be necessary when you talk to the bank, but it's also necessary for credit holders to see your strategy, how you see yourself moving forward. And those kinds of budgets, even in their very simplified form, tend to work very effectively in making credit holders feel comfortable with this approach.
So if organizations already have a budget, what's the need for creating this additional cash flow budget?
Well, the reason is pretty simple. Bankers see money in relation to time. The annual summary budget that you use really only reflects in total your solvency. In other words, your eye drops down to the bottom line, and you can either see that the organization has money or doesn't have money or is breaking even. But the banker needs to see income and expense on a regular basis, weekly, monthly, et cetera. But they need to see the flow of income and expense so that they're able to see what kinds of tools they can rent to you. Depending on how your cash flows through the institutional year, there are different tools that bankers have that are appropriate. So it's vitally important for them to see how that cash actually works. And so therefore you want to use a cash flow budget. if you're making projections, you can use two approaches. One is you can get a cash flow forecaster, which we created and which is licensed through Josie Bass, our publisher. That's one approach. The other approach is you can simply do it yourself. You take a look at your cash flow budget, you do some rough projections based on a percentage of increase or decreasing income, or increasing or decreasing expense, and you sort of plug those scenarios in. You know, as we do, that forecasts are not predictors of the future. But what a forecast does is it enables somebody else to see how you imagine things are working out. And that, in terms of bankers, is a particularly important consideration.
Can you talk about the risks for credit holders?
Well, in 40 years, spanning an awful lot of organizations, we've never heard of a default by a nonprofit organization using this approach. Now, having said that, I think it's important to understand that defaults happen. They're a reality. And so you want to be very careful in cautioning credit holders to put in no more money than they would be willing to lose. You show them your cash flow budget and your projections, just as you would the bank. And if they're comfortable with this approach, you have them sign a formal contract, which is in the manual. And this means that you and your credit holders and the bank all understand the relationship that you have to this collateral.
What if the organizations need more time to repay that line of credit?
Well, this is again is where the power of cash collateral really shows itself. So long as you maintain your collateral, the banker is going to understand your need for financing over time. And typically, the banker will talk to you about a term loan, which may be 3, 5, 10 years. In the case of Folk Life, they took out a 10-year term loan, paid the whole thing back in 5 years. It worked out very, very well for them. Another case that we worked on was an organization that was a private school that that started with 16 students and 18 faculty members, and obviously was not going to be able to survive on tuition. We met with the parents. They formed a credit holder group. We went to the bank. The bank agreed to lend. And then we showed them a series of projections at the bank that this organization would hemorrhage money for 7 years, that they would not break even for 7 years. And the banker said, well, if you keep the level of collateral equal on a dollar-to-dollar basis with the money that I'm lending you, I'll ride with you for 7 years. The bank did. The organization broke even in 7 years and is now operating with a surplus.
So, but what does happen in the situations of default?
Well, we've never had that experience. So our response here is purely hypothetical. We've discussed this matter with many experts, accountants, tax attorneys, senior bankers. And the consensus is that if a default were to happen and no default insurance were in place, then a portion of the funds held by the credit holders could be treated as a charitable donation, in which case those people who deduct would be able to reclaim a portion of that money as a tax credit. On the other hand, if there is default insurance in place, then that donor or that foundation would pick up the balance of the losses involved.
What is default insurance? Can you talk more about that?
Yeah, it's basically a form of insurance that's provided by a foundation or a donor that guarantees the bank's repayment. Now, the term itself is very unattractive. It's also called credit enhancement, which sounds better. But basically, what it is a willingness of that institution to say, we will take what is called the third position. the organization is responsible for its borrowing first. Second, if it defaults, then the credit holder funds would be retained by the bank. And third, the default insurer would step in and pick up the remaining costs. Although this is something that's done in the commercial world all the time, it's very rare in the nonprofit world, although we have worked with a number of foundations and donors who agreed to do this. And the reason they agreed is, first of all, there isn't much of a history of default, but more importantly, this is a way for them to enormously leverage their support for a lot of organizations. They can increase their support dramatically by encouraging organizations to safely have credit holders, for those credit holders to create collateral for the bank to lend the money, and now you have a new pool of funds available in the nonprofit world for use for a lot of different purposes.
So, I mean, once an organization has credit holders and collateral, what's the next steps?
Well, the typical scenario is aggregate the funds that the credit holders have put in, and when you have enough of them, to purchase a jumbo CD. The credit holders do something called hypothecation, which is a fancy way of saying they simply pledge these funds in this collateral to the bank. The bank then has a credit agreement that everybody looks at and agrees to. And at that point, the banker lends you money.
How does an organization demonstrate that they can repay the debt?
Well, the most crucial piece of that is through the use of a cash flow budget, which links time and money, and also some cash flow projections for the coming year. By projecting cash flow into the future, an organization can forecast its intent. It can provide in a concrete fashion a sense of direction, where it's heading. Cash flow forecasting is an organizational strategy expressed in numbers, and it gives heft to goals and objectives. It also gives the banker the information he or she needs to imagine how you intend to pay back your borrowing. And it also opens the door to the use of different kinds of tools on the part of the bank. And it gives your credit holders and your board members an opportunity really to see what's going on. Now, for the sake of brevity in the manual, we did not include an item-by-item cash flow budget. Instead, we use something that we've often used, which is a very simple, a three-line summary budget with some helpful footnotes. And since we're on the subject of footnotes, we're often asked, why do you need footnotes? People can see the numbers, they can understand your budget without them. Well, the reality of the situation is that an awful lot of people can't. They look at the budget, but they can't necessarily see at what the numbers represent. Footnotes are a way for you to explain not only the items in your budget, but also your formulas, your ideas, your thoughts about different things. And what it provides for the credit holder is an opportunity to see your logic. What it provides for the bank is a way to see a path forward in terms of repayment. And your banker is particularly going to be interested in this kind of budget. This is what all bankers ask us to provide, cash flow budgets.
So say you've got the collateral in the form of the credit holders fund, and you've got a cash flow budget, projections for the years ahead. What then? What next?
You combine the funds, you keep track of who parked what and when, and then you buy a jumbo CD for an annual term. Terms vary today in terms of banks. Fewer banks are making long-term CDs available, but there are some banks that do. And your credit holders who have signed the contract with you, signed the form that the bank provides, and there you go. The bank lends and you're in business.
What should folks be asking from the bankers?
Well, the first thing is to schedule a talk with the banker right in the beginning to kind of help them understand what it is that you're proposing. For many bankers, the idea of lending to nonprofits, as I discovered in Boston, is very unusual. And so because they don't necessarily understand how nonprofits work, there's a great deal of anxiety about them. There also is a certain degree of paternalism in philanthropy about nonprofit organizations, staying away from banks, those big bad banks. Instead, we should have special loan funds. But in truth, the crucial thing is that when you meet for the first time with the banker, you should have a general idea of how much money you need. You should have a sense of how you're going to form the collateral through the credit holders. If you share a cash flow budget and some projections, the banker can figure out what kind of instrument is appropriate for you. And, you've established a relationship. In your second meeting, you now have the cash. And now you're ready to have a serious talk about terms and conditions with the bank. And if you don't like what you're hearing, or if you're uncomfortable with the bank, this is the time to take your money and go to another bank. And people do this all the time. I should say that in 40 years, we have never had a client who was denied a loan. And these are often organizations with some very, very serious financial problems.
But some banks may be harder to deal with than others, and you just move on.
You move on, exactly.
Yeah.
Bankers share prejudices like other Americans. And we found, as we worked with religious, racial, and ethnic groups, that sometimes the banker has memories of discriminatory banking practices. But this method is a method that, again, trumps all of that, pardon the pun, and enables people to borrow effectively. Again, the notion of being fully secured is what does that.
What does the banker do with the collateral?
Well, they give you a form to sign that pledges the assets, and that's the first thing. And this form is a variation on a kind of lending that has been around for centuries. I mean, there are clay tablets from Mesopotamia that document this kind of borrowing going on back then. So there's no great mystery to it. The banker takes your funds, puts it in a certificate of deposit, gives you a receipt, gives you a credit agreement. You borrow the money, and you're off and running.
Well, if your line of credit is in place, how do you explain all this to your accountant?
Well, this is the one area that I think is most interesting, because this form of borrowing is something that creates a problem for accountants. And the problem is this: the CPA who's auditing you will write down the asset value of, for example, an irrevocable trust, an endowment, even though you may not be able to touch the corpus, the principal of that money. So the money appears on your books, but you can't spend it. In effect, you can spend the marginal interest. Interestingly, the credit holder's money does not belong to the organization. And so therefore, the accountant will very correctly put down your borrowing as an expense, but can't give you an asset value for the credit holders. And so in talking to tax experts over the year, what they recommend and what we find works is you explain that the credit holder's collateral represents a quantifiable form of goodwill, and that there should be a note in your records that says, this is how this works, and this is what people have agreed to. And even though the money is not yours, it's theirs, you are deriving a tangible benefit from that quantifiable goodwill. And typically it works.
Well, you've exhausted my questions, so it's time to get some questions from our folks in the room. So there's a number of ways you can do this. You can drop a question into the chat, or feel free to go ahead and unmute and pose your question. If it gets unruly, we'll start asking folks to raise hands. But for now, if you'd like, just drop something into the chat, or go ahead and raise hands. Yes, I see a raised hand from Clayton. Go ahead, sir.
Thank you for this opportunity. Really well done, Richard and Anna. And thank you, Michael, for having this. I've been in a board for Earth Created for 5 years, and we have been solvent the entire time and have not needed this tool, basically. But I see the value of it, of course. But let's just say that we had $100,000 in cash already. What would be the benefit of maybe taking that cash over that we already have and using that as the collateral? And this is a two-part question. When you have this loan, doesn't the loan cost money?
It does.
And so how do you pay that back?
Well, you typically pay it back out of your normal operations. And what we find is that most institutions, particularly with loan repayment, because the amounts are fixed, are able to, in their normal operations, pay back. The interesting thing, and this is a little technical, is that the math associated with this suggests that organizations that have cash reserves, such as your organization, say $100,000 cash reserve, have a tendency to think of that as money that is available to them. They don't typically make judgments about inflation or the cost of raising the money. So in your case, I think it would be very good to reach out to supporters, people who support you, and ask them if they would be willing to collateralize a line for you, and then for you to utilize that as an alternative to holding on to that cash reserve. In other words, if you've got the money, you ought to be spending it to further your mission, knowing that you have access to credit as a vehicle to deal with questions as they emerge over time.
Thank you.
Great question. Other questions from our room? If folks are still thinking about it, we do have some questions that came in from folks during the registration process. So let me share one of those here, because we actually had two questions that I think touch on the same core question. One is how this might work with raising funds for a capital project, because someone also asked for options around financing solar projects. So how would this apply to capital projects?
Well, this is the manual that we presented you with is what we would call a foundational document. In other words, it explains the concept and it gives you the recipe, the tools for a pretty basic meal. That meal can involve a line of credit or term borrowing, and it also could be used in some cases for venture. The issues associated with venture are very, very fascinating because, again, the problem is not so much the question of money as it is the relationship of the organization to time. So, for example, we on a number of occasions have been approached by organizations that had no budget but wanted to have a facility. And that struck us initially as paradoxical. But rapidly, it began to become clear that if they had people who supported them and who were willing to park money with them, they could run a capital campaign in reverse. Instead of spending 2 to 3 years to accumulate money and then going out and building the building or the facility, they would borrow the money, which would give them the advantage of being able to work in an environment where inflation didn't have the same impact over time. And then once the facility was up and running, they would pay it back gradually over time. And in every instance where we've used this approach, that has in fact happened. So the idea of reversing the capital campaign using credit is a very viable option. it requires a little more sophistication, obviously, and it requires a little better documentation so that people can understand that the facility really will generate the gifts and grants and the earned revenue that you hope it will. In terms of solar, I think the issue again is trying to find a way for other people to support your effort at a time when people are feeling financially pinched. And there are people who may or may not be donors, but there are people who are willing to be credit holders. And those credit holders then become the vehicle for something that we call venture. It's not for the faint of heart, but it certainly is something that can be
the
done.
credit holders are also, like we said before, they're putting money for a certain period. So they're not in there forever. And you need to keep renewing credit holders as the CD comes due, then you need new credit holders. Some of them will up again and you'll need other people to come along too. So it's a good way to keep a growing number of friends for your organization.
Let me use an example, Annie, because I think you've made a very good point. A private school that we were working with decided that they really did need to have access to credit. And so they asked parents when the students arrived, if they would be willing to park $3,000 per student in a credit holder account.
Until the student graduated.
Until the student graduated or left the school.
Yeah.
And many parents thought this was a wonderful idea. They could afford it and they would do it. There were a number of parents who couldn't afford it. They just didn't have that kind of money. And so what we did was we created then an alternative. We said, for those parents who can't afford it on a private basis, we would like you to pay 2 points of interest. In other words, a couple of additional points of interest and not the principal, not the $3,000. And for some of the people who are wealthier, that means that they would increase the money that they parked from $3,000 to $6,000 or $9,000, and they would receive a couple of extra dollars for their effort. The families that were not as wealthy thought this was a great deal, and it was. The families that were wealthier were very happy to contribute, and so it really worked out well. The ongoing nature of subscribing credit holders is something that links with your development effort. In other words, the development department and the people who are talking about credit holders are often making the same pitch. And again, as I said earlier, if you go to Charlie and Charlie says, gee, I'm having a bad year in the market, I can't write a check to you for $1,000 the way I used to, you can respond positively by sympathizing with him, maybe buying him another cup of tea, and then saying, but what about parking $1,000 with us in this credit holder program? And to a remarkable degree,
for a certain period of time.
For a certain period of time, to a remarkable degree, people do this. They're happy to do it.
So I think we're at the point in time where I ask Richard and Anna, would you be our credit holder, please?
Sure, we would be.
Well, that was easy.
There you go.
Yeah, we love the idea. We're credit holders for bunches of organizations.
Well, great. And I wonder to what extent this would apply to another question we had from a registrant, which was how this might apply to resourcing for a documentary film.
I've worked with several documentary filmmakers in the past who needed to finance their efforts and were wise enough to not max out their credit cards at the rate of interest that credit card companies are getting for the money they're in effect lending you. So in truth, these filmmakers were borrowing money. They were just borrowing it from the bank through their credit card at 18+% interest. By going to friends, supporters, other people who are interested, by forming a credit holder group, by taking the cash, putting it in an account, getting a loan to get the film up and going, it is possible to do this. Now, it's risky because filmmaking, like playwriting, doesn't necessarily guarantee results. But interestingly enough, there are people who believe in the filmmaker or the playwright and are willing to engage in this activity. And it is actually very cost effective, certainly much better than using a credit card.
We have a question in the chat that asks, does the organization that's applying have to be a nonprofit? And this actually kind of connects a little bit to a question we got from a registrant, which was, would you qualify if you're not a nonprofit but are fiscally sponsored, which is pretty common for a lot of Arts WA grantees. So how much of this hinges on the nonprofit status?
It isn't technically about the nonprofit status, although the nonprofit status is what we focused on and what we still consider to be an appropriate venue. We have in the past worked with some businesses. There's a whole series of differences for commercial entities, some having to do with tax consequences, some having to do with expectations. So I think that while it is possible to do this, it's also something that one would want to think through very carefully. We had originally thought that a manual could be created for artists that would use this concept. And as we began to work with it, we found that the difficulty was that the individual versus the institution was really it was not only a harder sell, but in many ways it was much riskier. The artist may have a great desire to have support, and we certainly believe in that. But the difficulty for individuals versus an organization is a little greater. It's a little higher bar. Can be done, it's just a little tougher.
Right. For that questioner, just let me know in our little chat here if that answered your question fully. We've got one more that's actually a three-parter that came in from a registrant, which is, first, what kind of organizations qualify? 2, what are the current interest rates? And 3, what are the repayment timelines?
Okay, the first one is that nonprofit organizations are ones that qualify. So if you're a 501c3 or one of the other 501 variations, you would qualify. The second is a lesson that I learned years and years ago, which is never quote an interest rate unless you are offering that interest rate. So interest rates vary at this point, and that really is something that you have to work out with the bank. That's just a fact of life. So the interest rates typically are historically 2 points above the interest being paid on the CD. But that is not a golden rule. Not all bankers follow it. And so please don't quote me on that one. I think you should expect to pay normal interest. I don't think you're going to get a break on it. And the third question, compound questions drive me nuts. What was the third one again, Michael?
I'm surprised you got 2 of them.
Yeah, that's amazing.
Timelines. What are the repayment timelines?
Well, repayment timeline is a function of the tool that you're using. So if, for example, you have a revolving line of credit, the bank, or most banks, insist that you bring that line of credit to zero for at least 30 days during the course of a year. So the money in, money out notion has built into it a kind of a protection for you and for the bank. In other words, revolving lines of credit involve the idea that you're dealing with cash flow, and there will be periods of time where you have money, and while it might be tempted to spend it for more elaborate costumes, that's the time you pay down your line so you can keep using it. So long as it's collateralized, as Annie has pointed out, over time, the bank will continue to lend. If you have a term loan, then typically what you do is you establish, just as you would with a car loan or a mortgage, a fixed rate, and then that rate then tells you what it is that you need to pay on a monthly basis, for example. And again, the story that I mentioned before of the organization that required credit for 7 years before they hit break even. The bank was entirely delighted to lend to them every year to increase the volume of its lending because it had cash collateral in the vault. And if you think about it from the banker's perspective, this is the very best kind of collateral you could have. Cash, it doesn't get any better than that. And there's no downside risk because if anything happens, you have the cash. So it is a way of giving enormous flexibility to organizations, but it isn't a guarantee of repayment. Repayment really does have to come from operations.
Do we have any other questions from the room? Yeah, I see a literal hand from Amy. Go ahead.
Okay, so my question is just out of curiosity, do you find that you get a better chance of going through a credit union versus a regular bank?
Some credit unions have difficulty lending to institutions, which is something that I learned. I didn't realize this. We're credit union members. I think it's something that you might discuss with the credit union, but typically, even though they offer CDs just like banks, and even though they are not FDIC, but they have their own insurance, it seems to be different for different credit unions. So I can't answer that definitively. What I can say is the mechanism should work. It's banking 101. I mean, this is what bankers learn the first day in banking school. But whether credit unions are comfortable with lending to institutions as opposed to individuals, that I think would be something to explore. It's a good question.
Thank you, I appreciate it. Our town is very small. We have one bank, we have one credit union. So I thought, well, where should I start? What would be the best place to start?
I think the place to start is the bank, but I would drop into the credit union
And talking to them.
bring them
about
a donut and a cup of coffee and say, hey, listen, is this of interest to you? If it's not, walk across the street to the bank. We have, over the years, dealt with banks in some of the most remote areas imaginable. And bankers love this. They really do. They will welcome you with open arms because you're taking their downside risk with the quality of your collateral. So they find this very attractive.
Thank you, I appreciate it.
Thank you for the question, Amy. Anyone else with a question for Richard and Annie? Go ahead, Michael.
Hi, I've actually worked with Richard and Annie many times over the years on these very things, but both from an organizational side as well as on a funders side. And I can tell you that if an organization already has an unsecured line of credit, you're a slam dunk with the bank with whom you already have this by bringing the collateral now with you to turn that into a secured line of credit. And yes, you may need a term loan, but often this is a revolving line of credit. You're only drawing as you need it. You're not budgeting the money. You're just using this to smooth your cash flow. And on the funder side, I can't tell you the number of organizations over the years, by looking at that monthly cash flow, we were able to identify troubling cash flow curves before they were a crisis. Sometimes years in advance, because we saw a pattern over years. And by working with that organization on that, they were able to then go back, smooth out cash flow, do a little bit of budget tweaking, but again, smoothing out the cash flow and having access to the resources they would need if, in fact, that worst case scenario were starting to really loom on them. It has been truly helpful to organizations with whom I've worked.
Thank you for sharing that, Michael.
We have appreciated working with you and with organizations in your state. We did a webinar, my God, 5 years ago, just before COVID, that was sponsored by the 3 regional arts organizations, Idaho, Oregon, and Washington. And at that time, one of Michael's deputy directors, a very lovely gentleman, presented what would be called a form of secured borrowing. In other words, he was working with the symphony where board members promised, they in effect gave promissory notes to the bank to secure the borrowing. Fully secured borrowing is borrowing where the value of the collateral is equal to the amount that is borrowed. So it's a little different. Bankers hate the idea of promises because they know that they don't want to go after the people in the community who have the money, who have agreed to do this. It's a little bit like, co-signing on the lease for your college age kid and, not losing sleep at night over it. On the other hand, cash collateral solves that problem completely. In Michael's case, the organizations that were asked to fill out a cash flow budget as part of their application process instantly provided a profile that made it possible to identify organizations that might have, or as he suggests, years later, have serious financial problems. And so we were able to address those problems very directly.
Cool. Doing a thumbs up for Michael. It's been great. Any other questions? Okay, well, I'm going to pull up a slide here that summarizes what we've been talking about today. So just a moment here. So we're coming into the end here, and Richard and Annie, I'm not sure if there's anything you'd like to say in summary as we close out tonight.
Well, the summary here, I think, really captures the idea of people who have kind of crossed the threshold, who've decided that they want to give this a try. They talk to their board, they reach out to people, they use the manual like a cookbook with the recipes included, and they're getting a positive response. The key to this is a balance between the cash collateral and the information you provide in your cash flow budget. And the cash flow budgeting is something that provides an analytical tool for organizations that is really remarkably helpful. So it's worth it to do. The footnotes are worth, and using a 3-line budget for reporting at board meetings makes it possible for English majors to be right there with the people who have the serious financial background. They all can understand what's going on. We would like to urge you to try the manual. We designed it so that it would be completely DIY. If you have questions, let us know. But our experience in the past is that people using this manual have been able to set up programs and been very effective. We wish you well, and in these perilous times, we all need to do something that is positive and constructive and local and cooperative in order to deal with the environment that we're in. And it's an environment that may seem very forbidding sometimes, but it's also one in which creates opportunities for each of us to act, and this is our opportunity to act. Michael, thank you. And thank all of you for joining us.
I want to thank you both. I want to let you know this is a funny thing about state work, but my computer is a state computer and it is forcing me to do an update in exactly 3 minutes and 20 seconds. So we're ending on just the perfect timing. There are a couple of things I want to call out for the folks who are here with us tonight. We have a couple more info sessions coming up. Next week, we have our just general summer listening session. We want to hear what's happening in your communities and how we might be able to help, and also talk to you about some of our plans for the years ahead. And then we're teaming up with the LGBTQ Commission on a webinar about some survey results that they've done for their constituency here in Washington State. I'm really excited for that. So registration links are there in the chat. Please take them. And I really want to thank Richard and Annie for taking the time to talk with us about this. I want to thank all of you who joined us for your attention and your wonderful questions. And please stay tuned. We'll be emailing out the slide deck and a link to this recording to everybody who registered for this event. So thank you so much. Is there any other final words before my computer forcibly restarts in 2 minutes and 15 seconds?
Anything, Annie?
Nope, nope.
Nothing from me, Michael.
Thank you.
We're good.
Thank you. Bye.
Thank you.
Thank you,
I
everybody.
appreciate it. Have a good evening.
Bye.
You too.
Take care, everybody.
Yep.